All right. So, oh, sorry, I did not share my screen. Uh, all right. So, we're back. So we're gonna deal on chapter 14. We talk about the providers. Who are the providers? What actually they do, more especially in the care of a patient. Why also we talk about some of the things the provider do in places like Medicare, Medicaid, and others HMO and PPOs. Let's look at chapter 14, which is health insurance providers. Let's look at them. All right. Health insurance provider. This is the introduction. This is exactly what we're going to see on the video. We're going to look about HMO, PPO, the deductible, and the network providers. Of course, every Americans already know that the moment somebody said providers, you already know where the person is going. It's about health. So, however, it can be overwhelming and confusing when you hear the word providers, and we also understand this option is crucial for making informed decisions about your healthcare. Looking at the providers, want to get the best one for your healthcare. Everybody wants the best for his or her healthcare. You don't want to get a substandard. You want to get something good because health is life and life is health. So in a situation that you do not have a good provider, you know what it means. There is no mistake in health. In healthcare field, mistake is not tolerated. No mistake, because it's about life. So for those of us who are nurses here, you should understand that in wherever you're working, mistake is not tolerated. Because whenever mistake is involved, is what happens is life is involved. So today, health insurance landscape features a variety of providers and approaches, each with distinct advantages and limitations. The days of simple indemnity plans. This word is something everybody should look at. Indemnity, sorry. The one I highlighted is always seen in health insurance, but we never see it in life insurance. The reason is this. In health insurance, you are trying to bring the person back to his original position. So you can see indemnity in property insurance too, because you are trying to bring the person back to the property, back to its original position. That's where you see indemnifying. Indemnity is just reimbursement. It's just paying back. It's just bringing you back to the original position. That's exactly what the word is. So most times you may see it in the exam, it become confusing. Indemnification, just the process of bringing that person back to his original position before the loss occurs. Actually, you can just sell it reimbursement. I think that is the one that's the word, the one that is so clear to everybody to understand. So when you visit any doctor and submit bills for reimbursement, you have largely given away to manage care system designed to control costs while maintaining quality care. In this chapter, we're going to look at the evolutions from traditional health insurance to modern managed care network. The modern managed care network are the HMO and PPOs. We're going to try to see at the difference. So before we go into them, make sure you know the difference between HMO and PPOs. Even at your workplace, that will help you to be able to choose the best that can fit you. So that's why I said in this business, there is nothing like, apart from the business of you're getting license to sell insurance. Yes, agreed. But however, you learn things that can help you. If you can be able to differentiate between the PPOs and the HMOs, that will help you in making choices on the healthcare providers that will be able to take care of your families and your children's healthcare system. So understanding what PPO and HMO is will be an added advantage to you. So we're going to know which one is preferred, the preferred providers organization, which is called HMO, and the health maintenance organization, HMO. You can write it down so that at least you know the full meaning of those. For those who don't know, the few meanings of HMO and PPOs. HMO is Health Maintenance Organization, and PPO is Preferred Providers Organization. We're going to see the difference between the two, and probably the one you may like to choose. Even in your healthcare, at your work, when you start any job, they give you any benefits. Healthcare is one of them. So you can be able to make a good choice. So we're going to see we're going to be flexibility with provider choice and how point of service plans combine features of both. Point of service plan. We're also going to know what it is. So we are also going to examine group insurance, the most common source of coverage for Americans. Group insurance is the most source of coverage to Americans because almost every person is an employee. And most of the job, they give you group healthcare plans in your job, which is what we call benefits. One of the benefits every company, every employer has given in America is healthcare benefits. They give it to you. And that healthcare benefit lies between you making a choice of PPO and HMOs. So you should know what it means. So that is what the group insurance. Then this is included in any place we work. We're going to see how we can be qualified, the regulation, the protection that protects consumers, even coming to issue of when you are leaving your job, what happened with that insurance, that health insurance they give you. Well, that is all we're going to see in this chapter. It's an interesting chapter because it directly affects us. It directly, everybody. For the fact that you're working here in America, this chapter affects you because everybody have healthcare plans. So that's what we're going to see today. This video is just exactly what I just said now, but however, let's listen to it before we go to the content.
Welcome back. In this chapter, we'll take a closer look at the wide array of health insurance providers found across the United States. Understanding these options is essential for passing the exam, as they form the foundation of key concepts and classifications in health insurance. Imagine receiving a packet of health insurance options during a new job orientation. Terms like HMO, PPO, deductible, and network provider can seem overwhelming. Yet understanding these options is essential for making the right healthcare choices. Today's health insurance landscape has evolved from simple indemnity plans to complex managed care systems designed to control costs while maintaining quality care. Throughout this chapter, we'll examine traditional health insurance, managed care networks, group insurance plans, and the regulations that protect consumers. By the end of this chapter, you'll be able to identify key differences between traditional health insurance and managed care plans, explain how HMOs control costs and deliver healthcare services, distinguish between the four main types of HMO structures, compare features of PPOs to other healthcare delivery systems, recognize how POS plans combine elements of HMOs and traditional insurance, describe eligible groups for group health insurance, differentiate between contributory and non-contributory plans, explain group health insurance underwriting methods, identify alternative forms of group insurance, and summarize key federal regulations protecting consumers. Let's begin by understanding traditional health insurance policies and how they differ from modern managed care approaches. Traditional health insurance reimburses policyholders after they receive care, while managed care networks coordinate healthcare delivery and financing to control costs. We'll also explore how group health insurance, the most common source of coverage for Americans, works through employers and other organizations. Finally, we'll examine important regulations like COBRA and HIPAA that protect your rights when changing jobs or facing qualifying life events. By understanding these providers and regulations, you'll be better equipped to navigate the health insurance landscape with ease and precision. So let's get started. Take a moment to settle in as we explore the world of health insurance providers, knowledge that will serve you well both on your exam and in your future career advising clients.
All right, so that is what it is. That is just the introduction. Of course, if we can close today and you can be able to differentiate between HMO and PPO. I think that would be so great. So that when you go out there, even if you are speaking to people, there'll be difference, and you can go ahead and log into your employee benefits, more especially the healthcare section. If your enrollment period has not passed, you can do an adjustment. I did. Honestly, I did. When I know the difference, I did. I have to log in and be able to make a good change to our family healthcare plan, which I had at my work. So I did that. So learn and hopefully adjust your own. So let's look at the administration services only ASO plan. But the only thing, sometimes when you get into this providers issue, the combination and why this one can spring up again when the other one is serving is what I do not understand. I look at it, one person will be doing the job that all of them is doing is something one person can do. So in other words, you see that there's a small conflict. This one will say, I start from where this one stopped. Meanwhile, the one that starts from where the other one stopped is doing what the other one is doing. So you look at it, it becomes, I don't honestly, it gets confusing most times. But however, it is what it is. I still have to calm down and make a choice that will favor you, the choice you feel that can give you the best care, you and your family. So the administration services only ASO plan is a contract in which a self-funded employee welfare benefit plan contract with an insurer for administrative services while remaining responsible for the cost of claim. The insurer acts as a third-party administrator. I hope everyone understands what I mean. As an employee, you contract your healthcare services to somebody who is regarded as an administrator. The only thing he does is just one thing he does for administrative purposes. While you're responsible for the cost of the claims. So this person will just be directing you and telling you probably the right thing to do and all the things that involve in the plan. He or she is a third party, TPA. While you bear the cost, you self-fund it. You self-fund the plan. Then this other person as a third party will just sit there, be working between you and the providers. But however, who fund the plan is you. So let's look at Blue Cross and Blue Shield. Blue Cross and Blue Shield. Before now, either it's called Blue Cross before they come up and make it Blue Cross and Blue Shield. So this network of insurance service provider pays particular medical providers directly for a subscriber's treatment rather than reimbursing the insured. Blue Cross covers hospital services and Blue Shield covers individual healthcare professionals. So this is something what I can say. I'm not questioning what they are. They are so good. Blue Cross and Blue Shield is so good. But in essence, looking at it at the other view, Blue Cross is there before Blue Shield coming. And what does Blue Cross do? They covers hospital services. And what does Blue Shield do? They covers individual healthcare professionals. Can anybody come in the angle I'm looking at it? Can anybody come into the angle I'm looking at it? I think we are very, very online, so we will not say much today. So Blue Cross Blue Shield, they are a network of insurance service providers. They pay participating providers. So eventually what Blue Cross do is just like what some people have an organization where they employ people to go and work for somebody. You hire people to go and work. What do they call that services? Where you hire people, send them to different places to go and work for somebody, to go and work. So that's virtually in head. That's what Blue Cross do, because they bring providers to go and take care of people. So they are a network of insurance service providers. They pay participating medical providers directly for subscribers. Who is subscribers? Subscribers is me and you. We are subscribers. So They pay this particular medical provider directly to go and take care of subscribers' treatment. Before then, subscribers are reimbursed the providers directly. I mean, the insured, which is the subscriber. I mean, before then, the subscribers pay, they pay to the providers are paid directly by the subscribers. But now, Blue Cross now employ these medical providers for you, a subscriber, so that instead of subscribers paying you directly, the Blue Cross Blue Shield now pay you. Is it confusing? So instead of you, the subscriber, paying the providers directly, that's how it is the traditional way. But now, the Blue Cross Blue Shield will now bring providers, pay provider directly after the provider must have seen the insured. The insured is you, and you are also the subscribers. So Blue Cross covers hospital services. What they do is they cover hospital services. That's what Blue Cross do. And what does Blue Shield do? They covers individual healthcare professionals. Can you be able to differentiate their job? Is everybody confused on this? That this Blue Cross, what they do, they cover hospital services. And what does Blue Shield do? They cover individual healthcare professionals. That's their job. So let's look at, we are still going to see them when we go to the content. Let's look at capitation. Capitation is the method of compensating healthcare providers as calculated per patient rather than per service. You know, per patient rather than per service. That's capitation. Providers calculated what we are talking about, this compensation, all these things revolve around money. I hope everybody knows that. All this is revolve around what? Money. So capitation is the compensating method of compensating healthcare providers. It's calculated, of course, per patient rather than per service. So we're going to see which one is doing per patient and which one is doing per service. So that's what we're going to see. Which one pays per service, which one pays per patient, and which of them is cheaper, either per service or per patient. We're going to see which of them is cheaper. So Health Maintenance Organization, which is HMO, pay providers flat amount per person. HMO pay providers, they pay providers for what? Per person. Yeah, you have to know that. You may see it in the exam here. HMO pay providers per person on a flat amount. They pay flat amount. They pay providers flat amount per person. That's what HMO do. So if the person never use the service, the HMO wastes the capitation fee. What do you understand by waste the capitation fee? What do you understand by that? Waste capitation fee. Did they actually waste it? Anyway, it's left to everybody to answer. We all are adults. If they don't pay the service to the person, they don't pay the provider to the person, they said the HMO, they waste the capitation fee. They waste it, not waste, WASTES. They waste the capitation fee. So if the subscriber nearly utilize HMO service, the providers incur loss. So I want everybody to begin to see it in the angle of understanding actually what they do. He said, if the subscriber, who is the subscriber? You. If you heavily utilize your HMO services, what happened? The providers incur loss. So they expect you not to utilize their HMO services so that they can make money. If any of us here if you are managing like home care, where people you are servicing has HMO or PPO, you see that they do what they call recertification. You cannot see a patient except it's approved. They can give you a number of hours. You cannot go past that number of hours. Even if you are still need the hour, you need it. Because what? They want some services they can waste, some capitation fees they can waste. And of course, if they see more than required, they will cure loss. So that's going to explain something to you about their work, HMO and PPO. So let's see, case management, which is utilization review, is the process by which a specialist within a person's insurer reviews potentially large claims to discuss treatment alternative with the insured, which is case management. That's, of course, that's what they do. One of the things that reduces money is a good case manager. They make sure that you don't pay more than what you're supposed to pay. That's when you see a good one. Or when they're working in an organization that do not want you to waste your money. The case managers, they are wonderful people. They can make you pay more. They can make you pay less, of course. So change of life event is a commonly experienced occurrence that tends to cause individuals to buy insurance that is all related to a specific increase in risk. Marriage, divorce, or birth of child are common change of life events. They can make you to go into buying insurance that's all related to you, or even to increase risk. Remember, if somebody is living alone, as a young, let me use the example. As a young man, you are living alone. You may not, let's assume you have insurance. And within that year, you marry. You want to put your wife in insurance too, of course. And the next year, you have a baby. How many people in that house now? 3. So you're going to put all of them in insurance. That's what we call change of events, life events. Certificate of insurance. Yes, this is an issue that most of us do not know, and of which I will not say the companies that our employers are not doing good, they're doing wonderful. But however, what the law will say in a group plan is there is a certificate of insurance. And who's supposed to have that certificate of insurance? You, the employee. And who have the master contract? The master contract should be held by the employer. That's how it's supposed to be. You, the employee who is insured, should have the certificate of insurance. So in that certificate of insurance, you'll be able to know what plan you have. But I never see an employee that the company gives a certificate of insurance. I never see. I never received one. So I never see where it's separated, where certificate of insurance are given to people. I never see that. So, but the certificate of insurance is supposed to be with you. Quite the master contract will go to it's a single master contract will go to the insurance, to your employer. That is how it's supposed to be. So this document provides to group plan participant. You see, certificate of insurance should be provided to group plan participant. Who is group plan participant? You, all of us. We work in a company. The company gives us benefits. And one of the benefits is a group plan, the group life insurance, both for health and for life. Now, if they give us that, we are the participant. They should give us the certificate of insurance. So what does certificate of insurance do? It confirms coverage under a group plan. So if you have it, that confirms to you that, yes, I have a plan. If you have that certificate of insurance, it's confirmed to you that you have a plan. That's actually what certificate of insurance is. Through that, you can be able to know the plan you have and what it entails. So participants are covered on a single master contract and do not receive separate policies. Of course, that master's contract should go to the employer. It's also called evidence of insurance. So you have the certificate. Of course, it's an evidence that you have insurance. It's a confirm that you are under the group. So closed panel network is a form of network, HMO, in which providers deliver service within HMO facilities. You can see that this thing sometimes may be confusing. The reason why it's confusing, because you see this one up on top of this one on another one on top of the other one. So by the time you know them, you know all of them, you get confused. Now, apart from the HMO we're talking about now, we have not started talking about the PPO. We have what we call closed network, closed panel network. They say it's a form of HMO in which providers deliver service within HMO facilities. That's closed panel network. Now, we have what we call the COBRA group. It's a group that has 20 or more employees and must comply with COBRA mandate. What is the COBRA mandate? The COBRA mandate is an act which allows you, the employee, and their family to continue to receive services even when you leave the job, or when you get terminated, or when you resign. COBRA mandate helps you to continue to get service for at least 60 days. Sometimes it can be 30 days. What they want you to do within that 30 days or 60 days, what they want you to do within that period, you can be able to get yourself an individual coverage. It's no longer based on the company, because now you have gone out of the company, you should be expected to have an individual coverage in your health plan and in your life insurance plan. So the COBRA give you the opportunity to get it when you're out from job. I just experienced that. So with COBRA, you can convert to an individual life insurance or individual healthcare plan. Co-insurance, this is what everyone knows, is a cost-sharing formula in which the subscribers pay percentage of their medical costs up to an annual maximum. Co-insurance between you and your work sometimes it can be 20 versus 80%. Sometimes it can be 30, 70. Sometimes some employers can make it 50-50. So it's your duty to find out what percentage does your company share. In that case, we're going to talk about, is this company contributing or they're not contributing, what percentage? So co-insurance data formula where you share percentage of the medical costs. Now, community rating, we talked about community rating before. We'll come back community rating and experience rating. So community rating is what is a measurement that's used to project a client's level of risk. Insurers use it when underwriting and setting premiums for small group insurance plan. So community rating is used for what? Small group insurance plan. Experience rating is used for large group insurance plan. So please just know that between community rating and experience rating. Of course, it's used to project level of risk, and you knowing level of risk will determine the premium to be paid. So the insurer bases the client's group projected claim experience on the surrounding community claims experience and costs. So concurrence review is a form of utilization review in which healthcare is reviewed as it is being provided. The reviewer monitors the appropriateness of care with a focus on cost control. There are some nurses, their job is their clinical reviewer. There is a job. Some people, that's their job, that's what they do. Consolidated Omnibus Budget Reconciliation Act, which is the COBRA I just talked about, is the COBRA, Consolidated Omnibus Budget Reconciliation Act, COBRA. What is the mandate? It mandates the employer provide employees and their qualified beneficiary with continued coverage through the company's group health plan following their qualifying events. Contributory plan. You want to know in your company whether they are contributing to your cost of the coverage or whether they are not contributing to the cost of coverage. You should know that in your company, find out. And if they are, how much? Conversion privilege, of course, is what COBRA can bring to you. When you leave your job, you have that conversion privilege. The conversion privilege allows individual covered under a group plan to convert their coverage to an individual policies upon termination or retirement of their group plan coverage. Co-payment or copay is a fixed dollar amount that HMO subscribers pay for visit, pay per visit. If your subscribers, anytime you go to, if you have HMO, anytime you go for care, they expect you to pay per visit. So unlike co-insurance, the primary purpose of the co-payment is what? To cover administration costs. Credibility coverage defined by HIPAA. HIPAA is most important thing apart from securing your information. They are fully involved in insurance before now. So creditability coverage defined by HIPAA as previous coverage under another insurance plan when there has not been a break in coverage. The last is 3 days or longer. When an individual changes plan, creditable coverage for pre-existing condition reduces or eliminates any new waiting period. Dental maintenance organization, as we have health maintenance organization, we still have dental maintenance organization, DMO. It's just the same thing in health providers organization, management of that's HMO. Dental maintenance organization is a health maintenance organization for dental services. This one's for health, this one's for dental services. Of course, dentists contract with the DMO to provide services at an agreed upon fees. If you have DMO, then you have to get a provider. So you are the subscribers. Most often, you have to get providers that are within your service area. So subscribers have a primary care dentist, PCD, who manage care and provide referrals. Subscribers are responsible for co-pay and in some cases, co-insurance. Employee welfare benefit plan, of course, this is what is driving all of us to work. Believe me, some people are at work today, not because they necessarily need the monies. They can make that money they're making at their work from other sources. But they are just going to work just because of welfare, community or benefit plan from their job, more especially their health care and their group life insurance. Yes, some people are going to work today, not necessarily because they cannot make that money they're making elsewhere. They can make it where they are not getting clock in and clock out, but they choose to continue with clock in and clock out to maintain their healthcare plan. I'm telling you the truth. Some people have seen it a lot. They can make the money. In fact, if they're not working, they can make money they're making at work double. But they are still in that job just to maintain their family healthcare plan, which is very, very important. Because if you don't have, the children don't have any health plan, it's very, very devastating. In fact, which means that child is sick, you can't even take the child to hospital. If you do, the care provider will not be satisfactory. So employee welfare benefit plan, an employee welfare benefit plan is the Employee Retirement Income Service Act of 1974, which we call a RISA compliant plan that is funded by the employers and provide employees with benefits other than pension. That is a RISA. Enrollment period. Of course, most companies now, most of the employers now, based on their agreement with the contract they sign with the insurance company, may be in their enrollment period now. I think enrollment period is always 31 days or 1 month. I think so. It differs from some 2 months, differs from organization to organization. The enrollment period is a limited period during which all members may sign up for a group plan. So if you want to make any changes on your plan, if you want to go from PPO to HMO on your plan, the enrollment period will give you that opportunity to do that. So this period typically occurs once in a year and lasts for a set number of days. Of course, some companies, some organizations will say 1 month, 31 days, So evidence of insurability is a proof that a prospective group plan participant is an acceptable medical risk. Is an acceptable medical risk. That's evidence of insurability. Of course, there should be proof of insurability. Even when you are buying life insurance, you should show proof of insurability. In group plan, do you show evidence of insurability? Of course, no, because they use um, either community rating to do it. In that way, there is no way you can be able to go from one person to another. You do it as a group. So in group plan, you may not see evidence of insurability. Exclusive Providers Organization, EPO, is a hybrid of HMO. All these things you see exist in that your little money. You see all this, all the section is that money. It's not like, to me, I don't see it as a service. That's a personal opinion. I don't see it as a service. I see it as just everybody is fighting to attach himself to one place to be able to get his own organization to be getting money from this healthcare field. By the time all these small things drops, you see that the healthcare field, the money be spent will be much. But if one organization is actually providing all this, it'll be easy. Are they going to be overwhelmed? I don't think so. It's just a question of everybody trying to be his own leader. Of course, for example, is like the business you're about to enter. The dream of every agent is to become a broker. Yes, that is the highest rank you can attend to, and that's the highest contract you can attend to. Even me as a realtor, I'm a realtor. The dream of every realtor is to become a broker. You know, at that point, you are highest. You take decision by yourself. You work for nobody, you work for yourself. So I think this thing you're seeing here, people, a lot of organizations springing up, being like but working as. So springing up is calling for them to become independent and not answerable to anybody. In that way, the same money is being spread. The same money you pay is being spread. So when you have a lot of them, you see that what does it bring costs down? No, it doesn't bring costs down when you have a lot of them, because all of them is still fighting for the same thing. So with all of them coming up makes, to me, it will make healthcare costs high. So a hybrid of this EPO is a hybrid of HMO and is a preferred provider organization. And insured has direct access to any in-network provider without a referral. But no coverage is provided for out-of-network care unless there is an emergency. Of course, that is what HMO does. That's what all of them do. That's what all of them did. So let's look at the experience rating. We have talked about the experience rating yesterday. Of course, we say it's used for larger group. That's what we say. So it's a measurement that is used to project a client level of risk when underwriting large group insurance. We say community rating is for small group, experience rating for larger group. So insurers use it to do what? To help set the premiums for group plans. When you do on a larger group, is what? Experience rating. For smaller group, is community rating. What they're trying to do, they're trying to determine the group risk and will be therefore premium for that group. Yes, because what affects premium is your risk. What kind of risk you have will determine the premium. That's why when the time we did classification of risk, you see that those who have higher risk pay more in premium than those who have lower risk. The standard, pay less compared to what the substandard risk classification pays. The substandard risk classification pays 75% more than what standard and what preferred paid. Why preferred paid 15, preferred paid 15% less than what the standard pay. The standard pays the normal premium. Why the substandard pays 75% more than the standard and more than the preferred. So you can see, so the risk is the money. The risk classification, the level of risk is the determination of the premium in every insurance business, both in life insurance and in health insurance. So extension of benefits. What does it do? The provision allows individuals to continue to receive benefit for a covered claim, even after the individual is no longer eligible for coverage. We did a little bit yesterday about annuity. You can see that if you do life, you'll be receiving money until the person dies or the person passes. However, remember, even if the money you have, the principal and the interest you have finish, for the fact you are still alive, you'll be receiving money. So the prayer of insurance company then will be, can this man die so that we start wasting our money? So that's extension of benefits. You still be collecting claim, coverage, even if you are no longer benefit, even if you are no longer eligible for that. Franchise health plans, wholesale plans. This plan provide health insurance coverage to members of an association or professional society. Individual policies are issued to individual members, and the association serve as a plan sponsor. Premium rates are typically discounted for franchise plan. Group health insurance. You have it in your job. Insurance for group of people, often employees of a company under one master contract. Group health plans are available to employers, trades and professional associations, labor union, credit union, and other organizations. Insurance is extended to individuals in the group through the master contract. Group insurance doesn't require individual underwriting or evidence of insurability. So this should know that group insurance does not require individual underwriting. It's only when you are doing individual underwriting. That is when you look for evidence of insurability. Yes. But in a group, there's no individual underwriting. You do group underwriting, so evidence of insurance is not needed. So the group insurance doesn't require individual underwriting or evidence of insurance. Evidence of insurability solves. So we have again group model HMO, closed panel. Remember, we have open panel, now we have closed panel. What did open panel tell us? Let's look at open panel. There's a whole lot of them, a whole lot. They're fighting for the one money. Fighting for your money and so I think most especially we're gonna be taking the ones that we think that's important. Because they play a lot of them they mind as a Nigerian they say they plenty. A lot of them they plenty. There are a lot of them. So we're gonna look at I'll try to see whether we can see open panel. I thought we have open panel today. So the closed panel under this model, the HMO pays a capitation fee or predetermined fee to the provider group, while the group pays the physicians for services provided. In closed panel, the HMO pay the capitation fee. The capitation fee they don't want to waste. They pay this fee to the what? Group model HMO, that's the closed panel. Why now the closed panel will now pay the physicians for service provided. Let's look at it. Use your business mindset. I want everybody to bring out your business mindset. Look at this. In as much as we are learning to write our exam, we are equally learning for the business when we start it. So to know what to tell people. Open your mind and let's look at it critically. Look at group model HMO or closed panel. What do? HMO will pay a capitation fee or predetermined fee to the provider of the group. Why the group? This group model HMO is another group out of HMO. HMO pay them. They now pay physicians for service provided. So do you ask yourself, where are they going to make their money to service the company? It's from the same money. So what do you think that happened to the subscriber? Is his own money going to increase or going to decrease? Can anybody answer? Can anybody answer? I hope everybody's hearing me. I hope is everybody hearing me? Everybody's at work?
Yes.
Yes, we can hear.
We can hear.
All right. So I do ask questions. I'm talking about group model HMO and HMO. HMO we pay group model closed panel the closed panel will now go and pay provider that gives you subscribers service. Then I'm asking, how do this group model get their own money? Because they're going to maintain their own organization. How do they get the money? The money they get is from HMO. So I'm asking, do you think, based on this, healthcare to subscribers will be cheap or high? The money they will pay, the subscribers will pay, do you think it will be low or high?
High.
Of course, because what is the same money being distributed. But if HMO provide this service directly, I think the money will be less. But now they pay somebody to pay the providers. But if HMO can go and pay the provider this money directly, it will be less our problem. So you see this small money there, everybody's springing up groups to fight it, and before you know it, you, the subscribers, will be the person that will suffer it. So Health Insurance Portability and Accountability Act, HIPAA, is a federal law that was passed in 1997, which guarantees that American workers can transfer and continue health insurance coverage when they change or lose their job. You see what the job HIPAA does before. And if the job they do, not before the job, their real job. There are jobs that they guarantee that American workers can transfer and continue health insurance coverage when they change or lose their jobs. But the one everybody knows about HIPAA is privacy protection. That is the major one. If you're in healthcare, if you're a nurse or you're in healthcare field, the one you know about HIPAA is what? Privacy protection. But that's not really what they do. What they do is that they ensure that they guarantee people who are workers that when they transfer so they continue to get their coverage even when they change or lose their job. That's what HIPAA does. Now, Health Maintenance Organization, which is HMO, is an organization that offers comprehensive prepared healthcare service to its subscribers. HMO emphasizes preventive care, but also combine the delivery and financing of healthcare. Medicare will pay them. They will go ahead and pay providers. That's exactly what they do. So subscribers pay a fixed periodic fee rather than a fee per services. Rather than fee per service, they pay fee per patient, not per services. So indemnity plan, of course, which I say is reimbursement, is a major medical insurance, traditional insurance plan that are not involved with organizing or mastering providers. So the indemnity plan, which is a traditional insurance plan, is not involved with all these HMO and PPOs. It's direct payment to the providers. And I think that is, to me, if you left me to suggest, it's best to go back to the traditional way, which is traditional insurance plan, where if you go to see a doctor or the providers will pay directly to the doctor. Not going to somebody will collect the money now and pay the doctor. Because that's exactly what they're doing. Doctors did not collect the money directly from the source. Somebody will collect the money and pay the doctor. Yeah, that's what they do. So by the time they get it to the doctor, the doctor have to increase his money to be able to get what he wants. He's not receiving money directly. Somebody is contracted to receive the money. Now you go to get services, they will not pay the doctor. So they become the master of you and the master of the doctor. So that's exactly what's going on. It's disheartening. I don't understand, I don't like it. So Independent Individual Practice Association, IPA, HMOs, open panel. These HMOs are characterized by a network of physicians who practice in their own facility and participate in HMO on a part-time basis. That's open panel. They practice with HMO, participate with HMO on a part-time basis. Master contract, we'll talk about master contract before. Multiple employer trusts, MET is a combined multiple employers, 10 or more, into a single pool to provide group insurance. Multiple employer welfare is a lot, it's a lot. Natural group, an organization that exists for some reason other than to obtain insurance. So that is a natural group. Network model, HMO, closed panel. We have open panel, we have closed panel. This network model is similar to the group model. However, it involves more than one physician's group. The open panel is more than two group panel. I mean, more than is a group of people. That is the open panel. The closed panel involves more than one physician. Non-contributory plan is a group insurance plan in which the employer pays the entire group premium. If you are a job, you have non-contributory, means that the employer is paying everything. But I think it's hard to see non-contributory plan nowadays. Non-contributory plan means that everything you're getting is free. I'm not sure any company gives non-contributory plan. Notice of privacy practice, HIPAA. HIPAA requires health insurance plan to provide new subscriber with a notice of privacy practice at the time of enrollment or every 3 years thereafter. The notice details the health plan compliance with the HIPAA privacy rule and the consumer's rights. Open panel network, a form of HMO in which providers deliver services while working at their own offices in part-time basis. Participating providers, doctors and hospitals that contractually agree to specific fees for services they provide to Blue Cross and Blue Shield subscribers. That's participating providers. Let me just help people to recollect something in life insurance. I asked it yesterday, and as I continue to ask it, so that people will continue to be in their mind. Which insurance company, we have two types of insurance company, which of them do participating policy and which do non-participating policy? Can anybody remember? We said it last night. In fact, it's like we used it to close last night. But I'm trying to repeat it because most time you see it in the exam. Which type of insurance company offers participating policy and which of them offers non-participating policy?
Mutual participating, while the stock market is non-participating.
That is a stock company offers non-participating. Correct. All right, yeah, that's correct. So point of service for this plan is combines in-network care that's similar to HMO with limited out-of-network care. That's point of service, POS plan. Pre-admission certification, of course, we don't need that one. Preferred providers organization, which PPO. The main thing we are doing, we want to differentiate here today. I want everybody to pay attention to is HMO and PPO. All these other PPP, I don't even pay attention to them. And probably you may or may not even see them in the exam. The most important one, which is the master key, are the HMO and the PPO. We're going to try to find out the difference between the two. You're not going to go to exam and begin to see all these pointers, all this and that. No. It's too much. There's a lot of small ones. All of them come out of HMO and PPOs, all of them. So preferred providers organization are sponsored network of healthcare providers that contract with the PPO to offer their services to PPO subscribers on a fee for service basis at prearranged discount prices. When I see this report, I get mad with them. All right, look at HMO give services per what? Per patient. I hope everybody knows that. HMO provides service per patient. PPO provides services per service. Fee for service basis. HMO is fee for per person, per patient basis. So why a PPO say they are reducing discount prices because they provide per services? This one said, HMO said they are providing service in a cheap way because they pay per patient. So per patient and per services. If you look at it critically, if somebody will go to hospital, if they're charging you per service, which means any day you go, they charge you, like it's even difficult to differentiate. Then this other person per patient, so that if you go, they charge you as a whole. Then per service will depend on how many services they give you. So that's the two ways they differentiate themselves. Pregnancy Discrimination Act. Of course, before now, if somebody's pregnant, they see it as disease. they will not allow give the person a due care until 1978. That is when it stopped. So the act requires that women who are affected by a pregnancy, childbirth, and related medical condition, e.g. abortion, be treated the same way any other person for employment-related purposes. Before that, it's not now. It's not the same. Yeah, and some insurance company, if you are pregnant, sometimes they may deny issuing you policy. But that's awkward, honestly. Pregnancy is not disease. So it's not sickness. It's a natural occurrence. It's not sickness. But most insurance companies do not approve policies based on that. I don't know why. So primary care physician, PCP, of course, a doctor who provides general medical care for individual network members, typically of HMOs or PPOs. And they control all their referrals for specialized care, also called a gatekeeper. So they are called the gatekeeper. Also, they are called the gatekeepers. So the primary care providers are gatekeepers. You may see it in the exam. Your PCP is a gatekeeper. Of course, they're actually the gatekeeper because, let me tell you, every diagnosis comes from them. Every discovery of anybody's sickness comes from the PCP. So they are actually the gatekeepers, the PCPs. So prospective review, the form of utilization, because I don't want it. Qualifying event, COBRA, an event that qualifies workers and beneficiaries to access COBRA benefits. Qualifying event includes termination, disability, death, and divorce. So these are the qualifying events for COBRA. Remember, COBRA help you continue the care for about 1 month or 2 months after you lose your job, or due to disability, anything that can cause you to terminate your job. Yeah, they take care of you. Prospective review, service basis, service providers. So let's go to the rating now. It's confusing, it's a lot of them. So we're going to pay attention to the ones that we think we can see in the exam. Not all of them, because a whole lot of them, a whole lot. So traditional health insurance policies. What is traditional health insurance policy? What's traditional health insurance policy? Is under the terms of traditional major medical insurance and other small medical expense plan, consumers receive healthcare services from medical professionals. So we're going to see major medical insurance and minor medical insurance and medical expense plans. That's 3 things we're going to see here. So the insurance companies reimburses them for the cost of those services, of course. So commercial insurance companies, also referred to as traditional insurer, write major medical health insurance policies. Yeah, sorry, can I help you? All right, so let's look at the right of assignment built into, of course, everybody knows what assignment is. In life insurance, what is an assignment? Yes, let's look at this. It can be, what is assignment in life insurance? Can anybody remember what we said about assignments? Can anybody remember what we said about assignment in life insurance?
Is the transfer of ownership to another person, maybe to the beneficiary.
All right, yeah. So, like when you are transferring, let's assume you're transferring your car to somebody. what you have to give the person the title of the car. If you transfer the home to somebody, you still have to give the person the title. Now, for life insurance, when you are transferring their rights, the ownership of their life insurance policy, if you're the policy owner, you can transfer the right of you have to another person. In that, they use the term assignment. You assigned the ownership to another person. Please know that you may surprisingly see it in the exam. Assignment in a life insurance is to transfer ownership to another person. And when you totally assign the policy to another person, you do not have the right on that policy again. You cannot take a loan. You cannot make any withdrawal. You cannot make anything on that policy. You do not have any right to that policy again. The person who you assign the authority now become the new owner. So for that, you are the assignee, while the person is the assigner. So please remember that. So the right of assignment built into most commercial health policy allows policyholder to assign benefit payment directly to the healthcare providers, thereby relieving them of the need to pay the medical care provider. So since these plans indemnify the insured, they are also called indemnity plan. The traditional policy focuses on indemnifying the insured without reference to any specific work or provider. These types of plans have a national scope. Indemnifying the insured means that reimbursing the insured, paying back the insured, trying to bring back the insured to the original position. That's what it is, indemnifying means. So look at the example. It says, be sure to distinguish between major medical indemnity plan from hospital indemnity plan, which we have previously described in this program. Any reference to hospital indemnity means a plan that pays fixed daily amount to the insured, which is what? Hospital indemnity. They pay fees that pay that's the daily amount to what the insured. The insured are paid the money, then the insured will now go and pay the providers. That is hospital indemnity plan. Then, in the context of major medical insurance, any more than one meaning, all right, in the course of major medical insurance, any reference to an indemnity plan refers to a traditional reimbursement. Be careful not to get confused. We're going to go through it again so that you know. So the term indemnity can have more than one meaning depending on the context in which it's being used. So let's go back to the exam tip. It said, be sure to distinguish between major medical indemnity plans from hospital indemnity plan, which we have previously described in this program. Any in reference to hospital indemnity plan means that when you talk about hospital indemnity plan, it means that they pay a fixed daily amount to the insured. All these are traditional ways they're paying, the insured pay their bills to the provider. They paid a definite amount, a fixed pay daily to the insured. The insured will turn around now, pay the provider who give them care. That's the traditional way. Then in the context of major medical insurance, any reference to an indemnity plan would relate to traditional reimbursement, which is the traditional reimbursement we are talking about. That's the way they're doing before, the traditional reimbursement, which there is no this second, third, fourth, fifth, seventh parties that are coming to me, they come in to disorganize the plan, makes things expensive. Instead of making it cheap, they make it expensive. I feel like they make it expensive. So the term indemnity can have more than one meaning depending on the context in which it is being used. Let's see Blue Cross and Blue Shield. I like this company, Blue Cross and Blue Shield, the service providers. Blue Cross and Blue Shield were organized as service providers that offer benefit to subscribers in return for premium payment. They were organized on a local basis. Initially, some affiliates were organized as incorporated cooperatives. This organization aimed to secure additional subscribers, and we collect premium from members, administer the plan, and adjust losses. All this about your money. So subscriber benefits are service provided by hospitals and physicians within the plan. That's subscriber benefits. The subscribers is you and me. So the provider scheduled benefits for all covered services. Blue Cross was organized to cover the cost of hospitalization. Blue Shield covers physician's costs. So you can see the two work, what Blue Cross and Blue Shield does. Blue Cross will do what? They cover cost of hospitalization. Blue Shield, what they do, they cover physician's costs. Do you think Blue Cross cannot handle these things together? If they allow them to cover the cost of hospitalization, which includes cost of the physician's cost, I think they can. But I think Blue Cross decided to give back to Blue Shield so that Blue Cross can cover the cost of hospitalization, while Blue Shield will now cover the cost of physician costs. So eventually, the two organizations joined together to form the Blue Cross Blue Shield. So before they offer them individually, of course, it comes to our own special, our own personal criticism that Blue Cross can take care of two of them. But however, they come together, Blue Cross Blue Shield. That's why when they begin now, Blue Cross Blue Shield. Instead of Blue Cross taking care of the cost of hospitalization, while Blue Shield takes care of physician costs, they decide to merge together so that now they can take care of cost of hospitalization and physician's costs together. So that's good. So each is organized by state. So these traditional service providers differ from traditional indemnity plans in two ways. The Blues paid covered amount directly to the hospital. The Blues paid covered amount directly to the hospital. Participating doctors and hospitals contractually agree to specific costs for subscribers' medical services. If there were remaining state balances, they could bill to and paid by the insured. So this process that differ from commercial insurance, which reimburses the insured. So the Blue offer plan underwriting on a community basis. They base premium on the coverage cost and loss experience of the market or community they serve. Indemnity plans, on the other hand, use individual or group experience to rate individual policies and set premiums. You see, just like I said, there's a lot of them. So in that way, it's confusing. Just know that Blue Cross cover cost of hospitalization, and Blue Shield previously cover physician costs. However, they have joined together to become Blue Cross Blue Shield, means they are covering the cost of hospitalization and also the cost of the physician's costs. So they merge together before they work differently. Now they merge together. So here are the general characteristics of Blue Cross and Blue Shield. They could be referenced on a state insurance exam. So for each state, also pay attention to this. Blue Cross covers hospital expenses. We have said that. Blue Shield covers surgical and medical expenses. And that is what they mean by Blue Cross, they pay hospital expenses. Blue Shield paid physician expenses. So in the exam tip, they want you to know that Blue Cross covers hospital expenses. Blue Shield covers surgical and medical expenses, which is they pay physicians. Physicians are the people who conduct surgical and who are the people who conduct medical. So the Blue Shield covers their expense, physician cost, while Blue Cross covers hospital costs. When you go to hospital, a lot of things are involved in the hospital. The hospital section of the cost means what? The beds, the room, the toiletries, the water you drink, the food you eat, the clothes you wear. All those things are what? Hospital expenses. So that's what Blue Cross cover. Blue Shield, on the other hand, what they cover is the surgery you did, the treatment you receive. All those is covered by Blue Shield. So Blue Shield covers surgical and medical expenses. Blue Cross cover hospital expenses. Blue Cross and Blue Shield offer policies for individuals and group coverage. Blue Cross and Blue Shield members are referred to as subscribers. That's the group Blue Cross Blue Shield members. That's we We are subscribers. So I think of all this grammar we speak above, look at what they want you to know. Just know this for your exam. Specialty care scenario before managed care, the first of the case. So all these ones, we're not going to go through them. Just waste of time. Specialty care, seeking care, payment process, follow-up care. We're not going to go to that. So we're going to choose, we're going to be jumping them. We're going to choose the ones that we think that we can see in the exam. All right, let's look at managed care definition and characteristics. As the cost of medical care has increased, what do you think have caused the cost of medical care? All this PPP, PTT, all those things, they increase the cost of medical care. I'm telling you. So as the cost of medical care has increased, insurance has focused on trying to control the cost of medical care. Medical cost management is also referred as cost containment, claim control, or case management, and managed care. That's medical cost management. It's called managed care. That's why care managers, they control the costs. So managed care is the process of controlling how policyholders use their policies. Policies use deductible, which are amounts paid by the insured before the insurer begins to cover claims. Deductible. You have an insurance. If you have an insurance, there's deductible. In the deductible, they say you pay 20% of the cost or 2% of, but it's everything we do. In your home insurance, in your auto insurance, your cost determined by that percentage. How many percentage are you paying as a co-insure? The highest is 6%. That is the highest, 6%. In fact, let me start with your home. Your home, you have a new home. You're buying home insurance for that home. What is your contribution, which we call copay, in case anything happens? They give you 2%, they give you 3%, they give you 4%, they give you 6%. So all those percentage determines the premium you are paying. As a new home, you just enter into a brand new home. I'm talking now as a realtor. As a new home, you enter a new brown home that you know if all things are well, before you start experiencing by a design, by the civil design, I'm a civil engineer too. So by a civil design, you see that the American design, for every pipe, the design specification is at least 10 years. At least 10 years. So that's what they design. At least before you can start noticing, more especially the pipes are there, apart from the weather issue and every other fault that can come up, at least it lasts you for 10 years. The British design, which Nigeria uses, our own is close to 15 to 20 years. That's our design. So here is 10 years. So you just move into a new home. By that design, that pipe is supposed to last you. Some pipes can last 40 years, 50 years. They are still there, working fine for you. But let's assume, to be benefit of maybe anything can happen. At least you move to a new home, 10 years. The roof is new. The roof is not going to spoil, except there's weather issue. No, because of weather issue, that's why those design years comes down, because of weather issue. The roof is new. The roof is not going to they'll be destroyed except from weather. There may be no leak, except weather can cause all those, that weather is causing all those problems. So, but if under normal circumstances is working well, and you've bought a home insurance, a new home, you decide to put it, reduce it to 2%, go pay, in case if anything happens, 2%, you're going to pay more. Yes, you're going to pay more. On the home insurance, you pay more. Because you're telling them that if anything happens, you only prepare to pay 2%. And eventually, nothing will happen. So it happened to us when we moved into our home newly. because I know the deal. So the insurance person I contacted put our listing to, I think, 4%. I mean, he put it to 2%. I said, what? You put 2%? Why? He said, in case he could speak in grammar. I said, no. Can you increase it to 4%? He said, but are you guys going to be able to pay 4%? I said, increase to 4%. So as I'm speaking to you, where we are is 4%. And what did that do? It reduced our premium to almost, I think 90 something now. I think 110 or 105 monthly. So now what I'm going to do, by the time we leave here up to 5 to 6 years, I've dropped it down to 3%. When we get to 10 years, I drop it down to 2%. So some of this waste is, to me, apart from weather, or maybe suddenly something happened, to experience those damage that can lead you to pay more may not necessarily be there. If weather happened, the roofs may damage, yes. Or maybe the house caught fire. So if you look at, or before you get your insurance, look at all those factors and check where you belong. But the higher the percentage increase you have, the lower your premium, the premium you paid. The more you pay. So that's what you have to know. So the managed care, those care managers in the hospitals, they work a lot to reduce payment, because after all, what they bring out is what the people who are billing you will bill you on, whether it's hospital cost or whether it's a physician cost. Whatever they bring out is what that you're going to pay for. So policies use deductible, which are amount paid by the insured before the insurer begins to cover claims. A higher deductible will help limit claims and contain costs. So even on this deductible too, in your car insurance, is equally applied. Your car insurance is equally applied. If you have a higher deductible, it will limit the premium you are paying. If you are such person that drive carefully, that you have stayed 20 years, you never get accident, never hit anybody, or you really even drive, why putting it on 2%? You pay more on premium. Put the deductible on 4%. If you put it 2%, you're gonna pay more. In fact, you put it on 4%, it drop your premium, monthly premium down. Some people, their car even park inside. They drive it once in a blue moon. Then why putting the policy on that kind of percentage? You're just giving them money for free. So policies also use co-insurance, which specify the percentages of claims covered by the insurer and the insured. Co-insurance is what? Another essential way to share the cost of medical care. Shortened benefits period can also be cost containment mechanism. Regardless of forms or structure, there are at least 4 general approaches insurer may use for medical cost management: mandatory second opinion, pre-certification review, ambulatory surgery, and case management. That is a way you can use to review your costs. Can help you to review your costs, more especially mandatory second opinion. Most times when you go to have a particular diagnosis given, go for second opinion. One, that will help you to be sure of what you're going in, and two, that will help you because you're going to compare the cost for the two to know the one you're going to do. Pre-certification review, of course, help in managing care, help not to give unnecessary care. Certification is seen on HMO and PPOs. That's why most of them determine your care. Some of them will say approve 60 visits. If you have done home health care before, you understand what I mean. They say 60 visits, 30 visits. Meanwhile, that patient may need 90 minutes. Remember, they want to save some captivation fees. And if they continue to give you those hours, they will lose. So indirectly, who is suffering? The patient, because you do not receive all the full care you needed. In the event that if you receive all of them, they will lose. So they want to have some captivation fees, which they can waste. And their wasting is no, become theirs. Medical costs, second opinion, we're not going to go through them. Ambulance surgery, I'm not going to talk about them. Case management, of course, case management is a very good thing that they help us to reduce our costs. They review all the prospects, they review all the cases, all the admissions and all the rest. They reviewed concurrent review, they do retrospective review too. So these are the 3 reviews they go on to. The case manager utilizes reviews to performing their job, on making sure that you pay your fare of the good fee, not much. So these reviews are the prospective review, concurrent and retrospective basis. That's all these are reviews the case managers use in working, in making sure that they bring down the price, the healthcare price. But sometimes all of them we work to the benefit of their employers. But if not, they determine how much if you make a visit to hospital, the case manager determine how much you're going to pay. Because they get your visit, they get all that services provided to you, they now send it to the billers, the coders who will use it to get money for the company. So whatever they send there is what the billers will use, or the coders will use to say the amount that you pay. I think this is 10 o'clock. So managed care network. The managed care network are the HMO, Health Maintenance Organization, preferred provider organization, PPO, point of service plan, and exclusive providers organization, and discount medical plan organization. All of them, I get tired with them, honestly. There are lots. They are managed care networks. Health Maintenance Organization, HMO. I think this is 10:25. We're gonna stop here. We have meeting now. I don't know. I think it's not my character to stop now, but we get to stop. We have meeting right now. So we are fully booked from now to Sunday. So what it means that we're going to start here on Monday. Health Maintenance Organization, we're on 29% of this thing. It's a whole lot. This particular chapter, honestly, is a whole lot. It's a whole lot. But we're going to pay attention to those things that we think that we can see in the exam. I'll implore you to read on your own. Do some answers. Don't say you not read until we start reviewing again. Please have time, read on your own. Take the exam. No failure. If anybody fail, is a job you give yourself. You send yourself back to financial school. You have read everything you'd have done, get all your degrees. Now you have gone back to financial school. And which is the best school that you have? If you have this financial school before the degrees, you may even decide not to go and get the degrees, because even some of the millionaires we see today, the billionaires, some of them did not go to school. So you see that sometimes the degrees become something that is by the side. So please read, ask questions. We have a group. You can ask questions. If you do not understand anything, send it on the group. We can answer it. But most importantly, please practice and read. We see on Monday. Monday is the 9th of February. For those coming to Dallas, I welcome you in Dallas. I already, Chinyere, I think you are coming. So for those who are coming to Dallas, we already provided things for you guys, making everything ready for everybody to have a good...
No, Engineer Bat, I'm not coming.
You're not coming, all right.
I'll come next year. I'll go next year. By then, I'll have my license.
It's not about license. Anybody who don't have license can still it's not probably you don't have the time. All right.
But that's not what they said before, though. So
No,
Because
there was no time they remove people who don't have license. A lot of people who don't have license is coming. So it depends on what people told you, but there's a provision for everybody. Whether you have license or not have license, for the fact you have a code, you're already an agent. Remember, now that you have a code, you can recruit somebody. I hope you know that.
oh no.
Yeah. You can start your business now. So
I see.
So that is the more reason why you should be everywhere where those who have license are. So in that way, you can be able to know what they're doing. So for the fact you have a code, you're already in the business. You can recruit, but you cannot write policy because you don't have a license to write policy. Who is Hanson? Hanson Jahid. Jahid, how are you? I've not seen this name before. Hanson? Who is Hanson?
Hello, sir.
Yeah, how are you? Is this your first time?
It's my second time.
Oh, this is your second time. All right, you're welcome. Are you coming to Dallas?
No.
All right. So please, everyone should read. Great. Knowing that you can recruit now as an agent, because you have your code, you can recruit, but you cannot write policy. That is just the difference. You can recruit another person to you can recruit your people to come and start learning and start preparing for the exam. Two of you can write the exam at the same time, pass at the same time. That person is still recruit, means that person is still under you. So you can do that. You don't wait until you want to get license. But you cannot talk about policy because you don't have license to talk about policy. But you can bring in somebody to start learning with you. That person, you recruit that person on your name, under you. We can help you do that. More especially if you call me, I can help you do that. Recruit somebody under you, yes. While you are trying to prepare for your exam, that person can join you to be reading. However, that person is under you. So the business have started. Once you immediately have your code, the business have started for you. So that's how it is. So waiting until when you get license is only you get license before you can write policy. Or only you get license before you can have commission. That is also what it is. Getting license is. But if not, the business have already started for you that have already gotten a code.
Hello, sir.
Yeah, right.
Please, can you share the YouTube link, the YouTube link that you are live on right now? Can you share it on the group, sir, please?
All right, I'll do so.
Thank you.
Yeah. Right. Any other question? All right. So if there's no question, Jimmy, you are here in Dallas, I hope.
I'm here.
All right.
Yes.
I hope we see
yes,
you.
I will be there. Yes, I will be there on Saturday.
You'll be at the party?
I don't know which one will be party, but I will be there Saturday by 9 o'clock.
You know, come to the party on Friday?
I don't. What time is what time?
The party start from 6 p.m.
Oh, I will be at work. I will get off work by 9 p.m. unless if it will continue till then.
The party will be from 6 p.m. to at least 12 o'clock, 12 midnight.
Oh yeah, okay.
The attire is black or white? Black wear or white. That is the attire.
Okay, what of the attire for Saturday?
Saturday is just professional. Can be your suit. It's just professional, as if you are going for interview. You know, this is a good time. Since good time, wear your suit to cover yourself.
All right. Okay.
All right. Yep.
Okay. Thank you so much, sir.
All right. All right.
Okay.
Good day, everybody. See you guys on Monday by 8:30. And for those who come to Dallas, you're welcome and safe trip to Dallas. All right. Thank you, everybody, and bye.
Thank you, sir.